What's up, everybody? This is Sunko, the Korean bro. Today is 2022, July 21st, and let's look at articles. Okay. First, let's go to yahoofinance.com, market beat. Hmm. Uh, the good thing is we have a upward trend these days. Paladin Interactive had a 17% uh, positive last night. Hmm. And let's look at it closely. Netflix locked out advertisers for years, but now brands have big plans. Paladin just made a surprising move. What's next for investors? Paladin just made a surprising move. What's next for investors? Okay, Paladin has decided to halt manufacturing products in company-owned facilities. Its goal is to get back to positive cash flow, but better inventory management may be the key. Outsourced manufacturing could actually cause costs to go up. Hmm. Management is giving up cost control to improve cash flow. Power Interactive announced it was done manufacturing exercise equipment in company-owned facilities. Rather, it's turning to partners to manufacture its popular stationary bikes and treadmills. On one hand, this move was surprising because it was a complete reversal of Peloton's previous strategy. On the other hand, Peloton is under new management and it's determined to get back to positive cash flow. And it believes having partners manufacture its equipment will help it get there. Mm, let's see. History lesson in Peloton supply. In October 2009, Peloton paid $47.4 million to acquire Tony Fitness Technology, a Taiwanese company that had manufactured Peloton's bikes since 2014. At the time, the management said it believed that having greater control over our supply chain will enable us to strengthen and scale our production capabilities. 5 months later, COVID 19 was declared a global pandemic, forcing populations around the world to shelter in their homes to avoid the spread of the virus. Demand for apparel and home exercise equipment consequently soared. Revenue for fiscal 2020 doubled to $1.8 billion. At the same time, Paladin's management lamented an ongoing problem with procuring adequate supply. The company's backlog for exercise bikes at that time was a whopping $230 million, and customers were complaining about long wait times. Producing adequate supply, so they had adequate supply issues. Um, Management's best efforts to control supply weren't enough. 6 months later, Pat agreed to acquire Precourt for $420 million. And here again, manufacturing capacity was the first reason management cited for the acquisition. Manufacturing capacity was the first reason management cited for the acquisition, but the purchase may have come at the worst possible time. As the chart below suggests, demand for Paladin's exercise equipment was plateauing. As a result, inventory skyrocketed. As companies grow, it's logical for inventories to also increase. But Paladin's inventory growth greatly outpaced revenue growth. This means bike and treadmills were getting made, but not getting sold. Paladin's path back to positive cash flow. Before 2021, Paladin was consistently close to break even or cash flow positive. But as the chart shows, that dramatically changed in 2021 and has continued until now. Okay. Paladin absolutely has a path back to positive cash flow, but it might not be by outsourcing its manufacturing. Here's why. Hmm. Okay, what I'm doing is reading about history of Paladin Interactive, which is the company that I invested into. I spent quite a huge amount of money into the company named Paladin Interactive. At first, I thought it was gonna have good positive results on my portfolio, but now I'm like minus 60% on this one. But I really do think that it's gonna go up at the end. Um, Today we have a 17% upward trend, and it's gonna continue. Uh, I'm positive at this point. Anyway, let's keep on reading this article and see the point of this author. Okay, Paladin spending on inventory increased more than 500% in fiscal 2021, reaching $587 million, and the company has spent $473 million through the first 3 quarters of fiscal 2022, up 30% from the comparable period of fiscal 2021. The building of inventory is clearly the primary culprit behind Paladin's negative cash flow. So here it says building up inventory was the main problem for them to gain positive cash flow. So therefore, the remedy is slowing production to sell more of the inventory it already has. So they got huge inventory, which was the main problem. So they it slowed their production, right? Okay. When new CEO Barry McCarthy took over in February, one of his first orders of business was to slow equipment production. Paladin inventories peaked in the second quarter of fiscal 2022 and dropped sequentially in the third quarter. New CEO Beck McCarthy. Beck McCarthy is a new CEO. Okay. One of his first orders of business was to slow equipment production. Paladin's inventories peaked in the second quarter of fiscal 2022 and dropped sequentially in the third quarter. And expect further improvements next quarter and beyond. The potential problem no one's talking about. The potential problem we have. Paladin inventory is too big. Okay, like I said, it's too big. That was the main problem. Had $1.4 billion in inventory on the balance sheet as of the end of quarter third. As those bikes and treadmills sell through to customers, they will be converted into cash flow. As long as management doesn't spend too much, this can indeed be a path back to positive cash flow. Paladin's inventory is too big, but this has nothing to do with outsourcing or not outsourcing manufacturing. Paladin has too much inventory because management didn't actually forecast demand. Okay, they inaccurately forecast demand. That was the main problem. Outsourcing manufacturing at this point could rob its chances of getting back in the black. Consider that Paladin is now outsourcing its delivery. whereas it had carried logistics in-house before. It had logistics in-house before. On the surface, this is a capital-light approach to business. However, the cost per delivery was up in quarter third, hurting the company's gross margin. When things are outsourced, Pelton loses some control over its cost structure. Hmm. This is already happening with delivery logistics, and the same could potentially happen by outsourcing manufacturing. As Pelton's cost of goods sold had increased, its gross margin has fallen. If Pelton is choosing to get leaner when it comes to physical products and focus instead on the subscription service, slowing production will indeed be a catalyst to improve the profitability, which is a good for shareholders. However, by outsourcing parts of the business, management is giving up a degree of cost control, and that could become a new problem down the road. Okay. Will Pelton become profitable after its latest move? Will it become profitable after its latest move? Has decided to cut all in-house manufacturing of its exercise equipment. So, here it goes. They moved um mm, factory. They moved factory. Uh, they produced merchandise in the states before, and they now move it all to the somewhere else, not the states. Mm. This is the latest in a shake-up by its new CEO to improve the company's prospects. Shareholders should welcome the news as it adds flexibility to the business. The top at-home fitness business has struggled with a bloated cost structure. It has been a tough ride for Pal Interactive, whose shares have created 95% over the last year and a half. Mm. The pandemic was definitely good to the fitness innovator. As stuck-at-home consumers turn to convenient options to work out at home, but a reopening economy caused demand to fall and net losses to soar. To help keep costs under control, improve the financial situation, management just announced that they will halt all in-house production of the company's exercise equipment and will instead rely solely on third-party manufacturers. This latest move has the potential to better position Pound to be sustainably profitable sooner rather than later. Some I'm sure investors desperately want. Mm, okay, getting back into shape. Okay, getting back into shape. Mm, okay, the point is, they stop producing. Uh, you know what they're good at. Uh, Instead, they are going to have third party manufactured. Uh, okay. Anyway, Unity software also had 13%. Hmm. Okay, let's go to market. Should you own either of these two semiconductors? Part two. And Get these three juicy dividend yields while they last. The top-rated consumer defensive stocks will yield above 3.5%. Can Europe live without Russian natural gas? Can Europe live without Russian natural gas? How low can DocuSign stock go? Oh. Is Netflix still a buy after losing 1 million subscribers? Are General Electric's downgrades a warning sign or a buying opportunity? ExxonMobil leads the oil sector have both peaked. Put still in your portfolio with still dynamics. Everything is lined up for Zscaler stock right now. Inflation not where investment fees are concerned. Monthly dividend stocks can provide solid income. Okay, let's read this. In yesterday's column, we wrote about how the semiconductor industry has had a tough first half of the year, but how at the same time there's a growing bull case around some of the strong names in the space, such as advanced micro devices. Hmm. Today, we'll take a closer look at a stock that's almost always featured beside AMD as one of the more solid semiconductors name out there, and that's NVIDIA. Through the first week of this month, their shareholders had fallen a full 60% from the all-time high they tagged last November. This brutal correction has to first be acknowledged by anyone thinking about backing them to start an uptrend in the near future. A deadly combination of inflation, recession fears, and supply glut have formed the perfect storm for semiconductors like Nvidia. Their stock has suffered accordingly as a result. But while it's unlikely that these factors will be around forever, they're definitely not going to disappear anytime soon. But if we look at the bigger picture, it's clear the risk and reward profile is starting to support the argument for a longer term position being considered. Fundamental industry shifts. 60% upside. Hmm. Legislation to aid the semiconductor industry passed a key procedural vote in the US Senate yesterday. Wow, 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 wow. Legislation to aid the semiconductor industry passed a key procedural vote in the U.S. Senate yesterday when Senate voted 64 to 34 to advance the bill some have called a cheap push. The pending legislation would give roughly $54 billion in subsidiaries to encourage manufacturers to build foundries in the U.S. and a new 4-year 25% tax credit to encourage companies to build semiconductor plants in the US. This fresh fundamental tailwind boosted the momentum that was already appearing in NVIDIA shares from the bullish comments out of UBS last week. Okay. So legislation passed, which means what is it? Semiconductor industrial will possibly have a upward trend in the near future. The team there listed NVIDIA as one of their favorite semiconductor stocks, despite the fact that near-term risks remain in the form of weakening consumer demand and confidence and rising inventories. Analyst Timothy Akers is a fan of NVIDIA as it goes about building more stable revenue sources around its GPU and software moats. He also feels the strength in the data center that has been talked about recently could be strong enough to provide a cushion if there's a correction in gaming. This theme of simultaneous strength and weakness was also picked up on by the team over CD earlier this month as well. Analyst Atif Milk there it reiterated his buy rating on Nvidia shares, but lowered adjusted earnings in 2022, 2023, and 2034 by 9%, 7%, and 5% respectively. Hmm. Regardless of the near-term headwind, this is still a company reporting year-on-year quarterly revenue growth of close to 50%, even in an environment that has both rising interest rates and red-hot inflation prints. Okay, I get it. Good thing is, legislation passed. That's a good thing. Okay, and 25% cut on tax, uh, could possibly have chip maker uh, build uh, a lot more plants. Hmm. Get these three juicy dividend yields while they last. Okay. This shaping up to be an unusual in the year in the capital markets. Inflation is as hot as a Manhattan sidewalk. Interest rates are rising rapidly. And major stock indices are well off their 2021 highs. This has investors trying to figure out where to hide. In cash king in this environment, yes, it offers downside protection, but no upside. What about short-term bonds? Yields are moving higher, but with the prospect of more Fed rate hikes, the prices appear destined to go lower. Hmm. How low can DocuSign stock go? Okay, digital signature cloud company DocuSign stock has fallen, lost its CEO in this year's bear market. The enterprise e-signature business took an unexpected jolt higher during the pandemic lockdowns as you work from anywhere. Elastic office and hybrid workforce trends took shape. The pandemic boosted DocuSign stock from an obscurity in the 30s to a high of $314 before cratering back down to earth in the 60s. Investors are bagging the question, how low can this stock go? A reversion was expected for all pandemic stocks as economics normalized, but shares have fallen over 80% off its 2021 highs. This seems a bit extreme, but we're also experiencing a bear market that is punishing stocks with slowing growth and lack of profits. The digitization, data management, and digital transformation tailwinds will continue to drive the stock. Make no mistake, the company is still profitable and growing, just growing slower. While its core e-signature business is slowing down, the artificial intelligence powered contract lifecycle management agreement cloud platform is taking shape to be the next driver of growth. So, yeah, so it's important for a company to come up with new source of new source of driver that is new source of driver. Um, this entails not just e-signatures but all processes before and after ones, including negotiations, agreements, amendments, renewals, and record tracking. DocuSign has 1.24 million customers and over a billion users worldwide. The company grew its $300,000 average contract value clients to 886 in the quarter, up from 599 in quarter four 2021. Uh, its net retention ratio is 114%. At these levels, there's much speculation about being acquired by a large player. CEO Dan Springer abruptly unexpected announced his departure on June 21st, 2022, leading some investors to hypothesize that the company may be up for bids. Prudent investors can watch for opportunistic pullback levels. Mm. In line and lower guidance. Can Europe live without Russian natural gas? Oh, it's an interesting article. You know, what we know is that because of conflict between Russia and Ukraine, there's a sanction on Russia, and and export is banned pretty much. So Russia has had a lot of money, has had a lot of has earned a lot of money from exporting oil, but uh, because of ban, uh, they hardly earn money from exporting because it's banned, right? Uh, yeah, and now Europe has to uh, come up with some new kind of solutions because uh, in the near term they'd have low insufficient supply of insufficient supply of oil, right? So here it goes. Europe faced an energy crisis even before drama emerged about Nord Stream 1 pipeline reopening from Russia to Germany. While natural gas started flowing again Thursday after the major pipeline shut down for 10 days of maintenance, Europe will still struggle to keep homes warm and industry humming this winter. While natural gas started flowing again Thursday after the major pipeline shut down for 10 days of maintenance, Europe will still struggle to keep homes warm and industry humming this winter. This is because Russia has already slashed Europe's amounts of natural gas used to power factories, generate electricity, and hit homes in the winter. And Russian President Vladimir Putin has warned they could keep dwindling. Mm. Uh, Deliveries through Nord Stream 1 were cut by 60% before annual repairs began and were expected to stay well below the pipeline's full capacity. Government officials had feared the pipeline may not reopen at all, saying Putin is using energy for political leverage in his confrontation with the European Union over the war in Ukraine. There are key things to know about Europe's energy crisis. Did Russia cut off gas to Europe? That's an important fact check. Why is Russian natural gas so important? What's Putin gain? What can Europe do? Could people freeze this winter? Okay, let's read one topic. Why is Russian natural gas so important? Russia supplied some 40% of Europe's natural gas before the war. That's dropped to around 15%, spending prices through the roof. Um, and straining energy-intensive industry. Gas is used across a range of processes that most people never see. To forge steel to make cars, make glass bottles, and pasteurize milk and cheese. Companies warn that they often can't switch overnight to other energy sources, such as fuel oil or electricity, to produce heat. In some cases, equipment that holds molten metal or glass is ruined if the heat is turned off. High energy prices are already threatening to cause recession in Europe uh, through record inflation, with consumers having less to spend as costs rise for food, fuel, and utilities. A complete cutoff could deal an even heavier blow to an already troubled economy. Okay. Huh, it's an interesting article. Nord Stream 1 pipeline. What is Nord Stream 1 pipeline? It is the major European natural gas pipeline that runs under the Baltic Sea from Russia to Germany and is Germany's main source of Russian gas. The head of Germany's network regulator, Claude Muller, tweeted that gas deliveries could reach the pre-maintenance level of some 40% on Thursday. Although Russia's oil and gas exporters are selling less energy, spiking prices mean Putin's earnings have actually increased. Hmm. Oh, I can see the reason why Warren Buffett paid that much amount of money on energy industry uh because of insufficient flow of oil from Russia. The price of energy went up dramatically. The price of oil went up dramatically. Uh, in the near future, in the future ahead, this trend will go up. This trend will continue, according to Warren Buffett. Warren Buffett. Hmm. Seven agricultural technology stocks to buy as commodity prices remain volatile. Anyway, so Russian natural gas is really important, and without it, it's obvious that other European countries would suffer from it. Hmm. Is Netflix still a buy after losing 1 million subscribers? Posted its earnings this week, surprising many. The company reported losing 970,000 subscribers in quarter second to 22, but its profit and revenues increased. Oh, wow. Its profit and revenues increased. Profit surged to $1.4 billion, up from $1.3 billion, while revenue bombed to 8.6% year over year to $7.9 billion. Efforts were discussed to improve further its revenues and margins, including monetizing the estimated 100 million households that are not paying for the service and rolling out a lower service tier supported by advertisements. The unexpected improvement in the company's fundamentals has surprised many. Mm. The unexpected improvement in the company's fundamentals has surprised many, which led to the stock rallying shortly mm, after its earnings were posted. Is Netflix undervalued? Some investors and analysts now consider Netflix undervalued, but it's fairly even 50-50 split between the bulls and bears. The company currently has a 44% upside to the market beat consensus price target. The company is performing worse than compared to consumer discretionary companies. They collectively have a potential upside of 140% and consensus rating of buy, while Netflix has a consensus rating of hold. Will Netflix hold up during a recession? Netflix versus Roku is a competitor to Netflix in the movies and entertainment industry, but the companies have striking differences. For one, Roku's market cap stands at $12 billion, while Netflix has a market cap of 89. This gives Roku more room to outperform Netflix and deliver higher returns to investors. For a total return, Netflix losses have been steeper than Roku's over the last 3 years, with a minus 31% and minus 10% loss, respectively. Hmm. In terms of valuation, Netflix is cheaper across the most important ratios. Hmm. ExxonMobil leads the oil sector have both peaked. It's pretty easy to find stocks in free fall these days, especially in sectors like technology and travel and leisure. But energy giant Exxon Mobil is correcting in an orderly fashion. Before examining its current base, let's review its performance over recent time frames. Year to plus 47%. Before examining its current base, let's review its performance over recent time frames. 3 months, 1%, 1 month, 2%. Yes, you read that right. Throughout all those rolling time periods, ExxonMobil has notched the gains. Uh, that's despite a correction in the stock that began on June 9. It fell to a structural low of $83 on July 14, a peak to trough decline of 21%. Has rallied along with the broader market, with the stock advancing 4.2%. Is ExxonMobil representative of the broader energy sector or an outlier? And the sector's mid-June peak marked the apex for the foreseeable future. Uh, okay, this article pretty much talks about how ExxonMobil uh, do well, mm, even if we have like supply chain issues and rising inflation and stuff like that. Even in difficult times like this, uh, they have like notched gains, right? Obviously, probably that's one of the reasons why Warren Buffett also spent much amount of money on this company. Uh, I'll have to have rethoughts on investing on this company. Okay. Next article that I'm going to read is about Zscaler. Zscaler is also one of the companies that I invested much amount of money on. And let's read this article and what this author thinks about it. Schaeffler's investment research was built from scratch on Bernie Schaeffler's vision of providing accessible professional grade trading information to retail traders. Okay, here we go. Zscaler is a high multiple cloud security name that sold off nearly 70% in its peak to trough since November 2021. Okay, it's about like how this company grew so far and uh, hmm. Well, there's not much about it. Hmm. Let me skip on this one and read something else. Okay. Hmm. Overall, through this site named marketbeat.com, the important thing that I realized tonight was that Netflix is still a buy, and its revenue and profit went up mm, this quarter, and ExxonMobil, ExxonMobil, the energy company, is doing so well. And yeah, well, stuff like that. Anyway. Okay, let's go to here. Amazon makes $3.5 billion cash push into healthcare. New news. Twitter's earnings approach at a pivotal time. Domino's earnings disappoint as driver shortage bites. Okay. Too strong buy stocks are too cheap to ignore. Mhm. Our long-term outlook for the stock market remains bullish. Here's our two stocks that Oppenheimer likes. Too strong buy penny stocks that could go boom. Cheap stocks to buy. Should you ever watch these 5 growth stocks? Trading NVIDIA, AMD, and Intel as Congress votes in chips buying stocks now could bring you pain over the next few weeks, but you'll be thanking yourself as a year from now, these analysts say. Okay, JP Morgan and other big banks are suspending stock buybacks. Investors aren't happy. SAP revenue surge, but guidance cut amid shift to cloud. Americans are getting the stock market really wrong. Elon Musk says remote workers are just pretending to work. Turn out he's right. Imagine manager source on big talk stocks. While Microsoft is an exception. Show stock tops key benchmarks, score strength ratings hike. AT&T stock dropped despite adding subscribers. Here's why. Which stocks are showing rising relative strength? Carnival stock tumbles after new share sale. What the market is worried about? Bitcoin is soaring, 3 signs rally is real, and 25% gains are had. AT&T falls most in 20 years after overdue bills hit cash flow. Gold has been a disappointment this year. What could change that? Nicola is caught in a strange conflict with former CEO Travel Milton. Adams moves deeper into healthcare when $3.9 billion deal for One Medical. Okay, let's keep reading this article. We got a lot of interesting articles tonight. Amazon makes deeper healthcare push with $3.49 billion One Medical deal. Amazon.com said on Thursday it would buy primary care firm One Medical for $3.49 billion, adding brick-and-mortar doctors' offices to its arsenal as the e-commerce giant pushes deeper into healthcare. The all-cash deal heralds a dramatic expansion of Amazon's healthcare ambitions, having piloted the virtual care visits for Amazon employees in Seattle in 2019 before offering such services to other employers and in other cities under the Amazon Care brand. We think healthcare is high on a list of experiences that need reinvention, said Neil Lindsay, Senior Vice President of Amazon Health Services. Healthcare is high on the list of experiences that need reinvention. In One Medical, Amazon is aiming to acquire a company with brand name customers such as Airbnb Inc. and Alphabet Inc.'s Google. One Medical is a primary care provider that offers both telehealth services and options to meet doctors in person at its 182 offices scattered across 25 markets in the United States. The e-commerce giant agreed to pay $18 for each share of One Medical, representing a premium of 76% related to the healthcare firm's closing price on Wednesday. One Medical shares were trading at $16. The news knocked down the stock of telehealth leader Teladoc Health by 8% in morning trading. Shares of drugstore retailer CVS Health and Walgreens Boots Alliance fell over 2%. There is a minimal antitrust risk with the deal given Amazon's limited healthcare footprint. Evercore, okay. Something new. Amazon, e-commerce company Amazon, it looks that they have a plan to expand their business, and uh, what they are trying to do is have a new industry, which is healthcare. Probably that's the reason why they acquired um, the company named the One Medical. Hmm. Okay, the next article that I'm going to read is Domino Pizza. Okay, let's see what this is. Domino Pizza's profit disappoints on higher cost labor crunch. Domino's Pizza Inc. missed market estimates for a quarterly profit on Thursday as the fast food chain struggled to cope with the soaring prices of raw materials and a staffing crunch. It's probably not only Domino Pizza, but also a lot of restaurants, and like the owner of restaurants also suffer from uh, the increasing fee of making food. Uh, and just like that, aligned with that, Domino Pizza also struggles. The world's largest pizza chain has had to spend more on ingredients, yeah, like I said, on from grains to oil since the Russian invasion of Ukraine, according to headaches of a company already grappling with rising freight and labor expenses. Okay, labor expenses, rising interest rates, rising interest rates. Hmm. Like right. While Domino's has tried to offset the cost spike with increases in delivery fees and menu prices, its gross margin fell to 36% in the second quarter from 39% a year earlier. Hmm. Next one. Too strong buy stocks are too cheap to ignore. Okay, the last few days trading have been enough to make our heads spin. Let's read the rest of the articles fast because we still have a lot of articles to read, and like out of time, right? Buying stocks now could bring new pain over the next few weeks. Hmm. You'll be thanking yourself a year from now. Oh, okay. Uh, I got like 10 articles, and I'm just gonna read only important part, okay? And then I'll move on to next one. Uh, Smart home tech segment. Universal Electronics. Universal Electronics produces remote controls, voice activated smart home hubs, smart thermostats, and home sensors, along with software and cloud services needed for device interoperability. The company's products offer solutions for smart home systems, home security, climate control, entertainment systems, even household wireless connectivity. Universal boasts that it ships or supports more than 100 million products annually. Universal maintains its reputation in the sector by the regular launch of new products. In the last few months, the company has announced the launch of new TV remotes, a smart thermostat, and voice remotes. The company was also selected by DNA, a leading telecom provider in Finland, to provide an award-winning Android TV remote. Despite these launches, Universal has had trouble gaining traction in earnings and revenues, and has seen a slow decline in top-line results over the past few years. UEIC has rationalized its cost structure, moved a portion of its manufacturing from China to Mexico to lower cost and reduce cycle times, and introduced multiple new products. The missing element has been revenue growth, with the company reporting a year-over-year decline in revenue in 8 of the last 9 quarters. However, with a growing number of design wins and some improvement in the supply chain, it looks like the company is on the cusp of returning to a steady pace of revenue growth beginning in quarter third. What was the name again? Universal Electronics. Universal Electronics. Universal Electronics. Universal Electronics. Universal Electronics. Hmm. Hmm. How bad is the mood out there right now? Try Max Bearish. So said Bank of America's latest fund manager survey on Tuesday that showed expectations for profits and growth at recessionary levels. Some see this gloom as a contrarian buying signal. After all, what if peak inflation and peak rate increases are just around the corner? The reason more people consider real estate to be a better investment than stocks, bonds, gold, cryptocurrency, or bank account is the value of an average American home grew by more than 20% between the summer of 2021 and 2022. For the third time in 4 years, survey found that real estate is what Americans consider the best investment. Wow. Just like Korean, uh, also American also think that real estate uh, is the best investment. Is what Americans consider the best investment. The stock market was preferred by 26%, while cash investment and gold followed with 7%, 9%. But what is wrong? Let's see. Despite the housing market is coming off the boil, preference for real estate remains high. For the third time in the past 4 years and sixth time in the past 10 years. Why do many prefer the real estate to stocks? Confidence in the stock market is improving despite the fact that the S&P 500 is down more than. Consider it to be a good thing to do when one's money is still relatively low, given its wealth building potential. Those who didn't pick it as a top investment name too much volatility. Oh, baby boomers. Those who didn't pick it as a top investment name too much volatility, being intimidated by or not understanding how it works, and the belief that it is rigged against individuals is reasons why they prefer other forms of investment. 44% of those aged from 58 to 76 named were likely to fear the stock market, compared to only 29% of millennials aged between 28 and 41. While there is certainly truth to the volatility stereotype, a lot of this fear comes from seeing the stock market as something convoluted and real estate is something real. Hmm. Okay, fear of volatility. Fear of volatility has made them trade less. Elon Musk says remote workers is returning to work. Okay, I'm done. It's getting hot and it's getting boring. Okay, this is it for today, and I'll see you guys tomorrow. Okay, bye bye.